Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. It can take Wall Street a little while to comprehend exactly what Tesla does. They deliver so much information at once, it does take a while to interpret, even from fanboys at times, let alone Wall Street analysts. In fact, it's really the numbers that they care about the most. It would seem any projections or targets Tesla provide have minimal or often negative effects on the stock price. For example, when I discount back the value of the company to just Shanghai and Fremont, then there is very little value placed on 4680 batteries, FSD, and basically none on robotaxis. But with these latest numbers we have from Tesla, that give us a good indication of the current average selling price and their margins. Well, these are solid numbers that we can do projections with. I swear you have to watch this video to the end because you won't believe the results. I also have a little gift for everyone at the end too. I haven't done any back of the envelope numbers yet on this, so I'm going to go through all of it with you, but I have a feeling that Tesla might not be far off a PE ratio of 100 by the end of the year if the PE was calculated solely on Q4 results. Then my theory is that investors will not accept a PE ratio of 100 relative to today's stock price. It seems far too cheap, especially this year. Great, sounds good. So we need to do some numbers then. In calculating these numbers, we'll be looking somewhat on the optimistic side, as in things going relatively well for Tesla, and they don't run into any major issues for the rest of the year, such as component shortages. Remember, this video is about how Tesla could double this year, not Tesla will double this year. So basically, we will try to find a way of calculating an estimated Q4 net profit and assign a valuation on Tesla from there. I'm not going to go deep into the forensics here, as it is somewhat speculative due to such little information available, but I think the numbers should be plenty close to see just what potential Q4 might offer us. Let's get started then. First, we'll calculate the deliveries for each model from each factory. Hopefully we see the Model X launch sometime this quarter, but I think that'd be too late to get any really decent numbers for X in Q4. But in the meantime, there's a good chance Model S has scaled up. Now, before Tesla closed down the lines to update the new Model S and X, they were selling about 15,000 units a quarter combined. But more lines will be added, probably similar to where they were before the Model 3 launched, selling around 30,000 units a quarter. I don't think Tesla will manage that number for Q4 though. They may be at that run rate by the end of it, but not accumulated over the months. I would therefore like to assign just a 20,000 units for Model S and X. I'm also going to assume that Tesla are only selling the Plaid versions of these models in order to work out the average selling price. Now, Model 3 in Fremont seems fairly consistent at 50,000 units a quarter. I think Tesla would rather ramp up the Model Y with additional lines, rather than the less profitable Model 3. Makes sense from a business standpoint. Now, Model Y is sitting currently at around an estimated 55,000 units, ramped up possibly 7,000 units from the previous quarter. If we continue that pace to ramp up, then we would be at 69,000 units for Q4. Remember, Fremont claim a 500,000 capacity for 3 and Y. 50,000 a quarter from Model 3 is 200,000 a year, leaving 300,000 available capacity to the Model Y, or 75,000 a quarter. So 69,000 is not impossible. We have seen Model 3 in Shanghai in excess of 25,000 units in several months, including even December last year. Also, remember Q2 did suffer some downtime in the Shanghai factories, which did affect numbers. So I'm going to keep Model 3 at 25,000 a month, or 75,000 a quarter. I would think that Model 3 is fairly ramped up there by that stage. As for Model Y, it should be pretty much at capacity for the quarter. Its alleged capacity is 200,000 units a year, which is only 17,000 a quarter, but they hit 15,000 just in May. Also, in the Q2 earnings report, we see the capacity for China has changed from 450,000 to over 450,000. Tesla like to play coy about what their capacities are, which means either I'm a delusional fanboy, or I think Elon might be sandbagging. Anyway, personally I think Model Y will also hit 25,000, same as Model 3, particularly due to the improved manufacturing techniques between the two. But how about we take an average number between the capacity and what Model 3 is producing, giving us 21,000 Model Ys a month, or 63,000 a quarter. But it doesn't stop there either, because in the Q2 earnings call, Elon said that we should get to see limited Model Y production from the new factories this year too. I think 10,000 units is probably a reasonable figure to use. Also, Q4 is always a really big push for the end of the year, to try and get as many cars delivered as possible, and will likely also push out some stock too. I think 5,000 vehicles from stock is also a possibility. Remember, this is not necessarily what I think will happen, but this is based more on how things could possibly happen. We'll place the 5,000 stock proportionally amongst all cars. Okay, once we include all of that, then we actually get a total of 292,000 units of production for Q4. A quick side note, current deliveries for the year are at 386,000. When you add 292,000, you get 678,000, which happens to be just 222,000 away from 900,000 for the year. Therefore, although I ruled out 1 million units, I do also see there's a good chance of reaching 900,000 units for the year. Anyway, 292,000 units for Q4. Wow, that's not far off 300,000, or a run rate of nearly 1.2 million, before the new factories are close to ramping up. Not a bad start for 2022. Alright, now we have to do our financials. First, we'll need to estimate the average selling price of each vehicle. So I've constructed a spreadsheet to create an estimate of how much each version of each model from each factory will cost. Now, bear in mind, we are in Q4. All the back orders for customers who ordered with lower prices have likely received their orders, so we will have a higher average selling price as a result. As you can see, I've created estimates for what might be the average selling price of each vehicle. When we add them in, we're at almost $16 billion of revenue. That is nearly up 60% from Q2. Hello? 60% increase in revenue over 2 quarters. I mean, that surely has to move the stock, right? Now, I've calculated the ASPs for Q4 and Q2, and we can see that due to these price rises and the Model S and X, we're now at nearly 10% higher average selling price, from $50,000 to $55,000. Okay, some of these cars do cost more to build, like the Plaids, but most of the others do not, as we just saw from the cost of goods sold in Q2. So even though it's a 10% rise in prices, I'm only going to take half of that and increase the margin by 5%. So we had 28.4% margin in Q2, and if we increase that by 5%, then we're at 30%. Therefore, I am adding the margin as 30% for autos. I've also kept the same regulatory credits we had received in Q2. This then gives us a total gross profit for autos of $4.8 billion, which is up over 68% from Q2 gross profit. Energy and services likely haven't done anything major by that stage. Energy won't have much effect on Tesla for some time still, possibly even about 2 years away. In case you didn't hear in the earnings call, but Tesla haven't made their LFP batteries yet. They're the only cost-effective batteries that can be used to scale energy. It's a little disappointing. I hope we also get to see an LFP battery day sometime too. Taking total revenue to $18 billion, which is starting to look a bit more substantial. It's also over twice what Q1 was in 2021. Revenue has doubled within 3 quarters. I know we talk about 50% growth with Tesla, but this growth figure is not for revenue, it's for vehicles. The growth revenue could be more than 50%, and Wall Street cares about dollars more than deliveries. Now, equally, I'm going to use the same cost as Q2 for energy and service, which now gives us total gross profit of just over $5 billion, compared to $2.9 from Q2. Now, perhaps R&D is up somewhat, and I'm not quite sure what for, but let's be cautious and increase it to $700 million. SG&A is likely also a lot higher due to further expansions, and possibly with Texas and Berlin, so I'm going to increase that to $1.2 billion here, over 20% rise from Q2. As for Bitcoin, well, let's just forget about that altogether, I think. Although we do hope we might be at about $100,000 there later this year. It should happen, if not this year, then next. Which gives us my favourite figure, because I think it's the best sign on valuing growth companies. Income of operations, at $3.2 billion. That's a 76% increase from Q2. Okay, this is getting exciting. We'll just use the same interest as Q2, it's insignificant anyway. Now I had Tesla at a tax rate of 21%, which was from my Q2 estimates, which was actually where things went wrong for me. Up to that point, I was only within 10% on income from operations, but Tesla only paid 9% tax on all of this, presumably being offset by depreciation. So Tesla saved 12% from depreciation, which is $155 million. It's likely Tesla will have at least that to depreciate again, but let's use the same figure again anyway. So we would take 21% of income before tax, and then subtract the $155 million from that to give us the amount of tax to pay, which is about $500 million in tax, giving us a net income GAAP earnings of $2.65 billion, up from $1.18 billion in Q2, which is a 125% increase, and a GAAP EPS of $2.33. Okay, sure, growth has been priced into the stock, but not this much. Perhaps we should try and look at it in a different perspective. What if we calculated what the PE ratio would be if we analysed this quarter's profit? That comes to an earnings of $10.6 billion. Not too bad. If I recall, that was the earnings of ExxonMobil at around the late 90s, when they were the largest corporation in the world. But At the time of this video, we're dealing with a market cap of $621 billion. Well, get this. Here's where it gets absolutely crazy. If Tesla achieved this earnings in Q4 2022, and the stock price was at the price it is today of $621 billion, well, that comes in at an annualized PE ratio of just 59. Yes, Tesla would have a PE ratio of 59 if Q4 went like this, and the stock price had remained the same. But wait, we still don't have Berlin and Austin up and running yet, save around 10,000 units. And we know the capacity that they generate is 3 or 4 times. Okay, I'm starting to feel a little bit lightheaded. This is too crazy. It's a lot of money. So what PE ratio would you assign to Tesla then? Well, probably 500 to 1,000, right? But that's you and me. What we want to know is what the street thinks. Look, in all honesty, I don't see why a PE ratio of 150 to 200 is out of the question, which is a market cap of 1.6 trillion to 2.1 trillion, or a stock price of $1,660 to $2,704, or 150% to 333% return from today. So yeah, I would say there's a good chance Tesla can double this year. Now, once you wipe all the drool off your faces, I've also shared this spreadsheet with you all. It's free to download. The link is below in the description. I don't ask you to join Patreon or anything to use it. However, I would like to hear your feedback on what results you get when you play around with it, or if you might find something I've overlooked. But this is super exciting, and just more of the part of the new intel that we're getting from the Q2 functions. And if you like this, then let me know if you'd like me to start estimating the 2022 potential too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.